Every investor faces the same merciless battlefield: ruthless market swings, endless streams of conflicting advice, and the seductive promise of quick riches. But the deadliest foe isn't the market itself. It's the emotional storm raging inside us. Fear, greed, panic, and FOMO aren't just feelings. They are invisible traps that derail even the smartest investors, costing billions in lost wealth and shattered peace of mind. What if there was a way to break free from this cycle? To build wealth with a calm, rational mind that no market chaos can shake? This isn't about chasing the next hot tip or gambling on trends. It's about adopting a timeless philosophy, Stoicism, that turns investing from an emotional roller coaster into a disciplined journey of growth and tranquility. In this guide, you'll discover 7 Stoic pillars that serve as your compass through market mayhem, empowering you to invest with wisdom, discipline, and inner peace. If you're ready to stop reacting and start mastering your money and your mind, this is the path for you. Number 1. Embrace the dichotomy of control. Focus on your process, not market whims. At the core of Stoicism lies one of its most powerful teachings, the dichotomy of control, the clear, unwavering distinction between what we can control and what we cannot. For investors navigating the turbulent seas of the financial markets, this principle is not just philosophical, it's essential. It separates the path to consistent success from the chaos of impulsive decisions and emotional turmoil. Imagine the daily life of a typical investor. The stock market opens, and instantly a flood of data arrives. Prices fluctuate wildly. Headlines shout doom or promise. Analysts predict crashes or rallies. Social media buzzes with hot tips, conspiracy theories, and fear-mongering. The noise is deafening. The natural reaction? To react, to check your portfolio obsessively, to second-guess your strategy, or to chase the latest sure thing. But here's the brutal truth. None of these market movements, news flashes, or crowd behaviors are within your control. You cannot control the economy, government policies, or the whims of traders across the globe. No amount of watching charts or refreshing news feeds will grant you power over these external forces. What you can control is your own behavior. You control the decisions you make, your investment strategy, how much you choose to save and invest, your willingness to educate yourself, and critically, your emotional reactions. The Stoics teach us to recognize this boundary clearly. Effort spent trying to master what's uncontrollable is wasted energy, often leading to frustration, anxiety, and poor choices. Consider 2 investors during a sharp market decline. The first sees their portfolio drop and panics, selling at the bottom to avoid further losses. The second acknowledges the market's volatility, but trusts in their pre-established plan, continues contributing to their portfolio, and views the downturn as a natural part of investing. The difference? The second investor understands and embraces the dichotomy of control. They focus on what they can manage, not on the uncontrollable market gyrations. This shift, from obsessing over unpredictable events to mastering your own actions, is transformative. It frees you from the emotional roller coaster of market investing and cultivates patience and discipline. You learn to anchor yourself not in the shifting tides of prices, but in the steady lighthouse of your process. This means developing and adhering to a well-crafted investment plan, which includes consistent savings, thoughtful diversification, periodic rebalancing, and ongoing education. These are your tools, your control levers. By committing to these, you build resilience against market chaos. Moreover, focusing on the process transforms your definition of success. You no longer measure your worth by daily portfolio value or short-term gains, but by your discipline and rationality. Did you follow your plan? Did you avoid impulsive reactions? Did you maintain your composure and make decisions based on logic, not emotion? These become your true indicators of success. In practice, this also reduces anxiety. When you accept that market volatility is inevitable and out of your hands, you're less likely to suffer from fear or regret. Instead, you stay grounded, make decisions aligned with your long-term goals, and avoid costly mistakes triggered by panic or greed. Ultimately, embracing the dichotomy of control is the foundation for becoming a Stoic investor. It's the mindset that turns chaos into calm, impulsiveness into discipline, and uncertainty into steady growth. When you master this principle, you empower yourself to invest not just wisely, but peacefully. Number 2, cultivate rationality over emotion. At the heart of Stoicism lies the reverence for logos, the faculty of reason and logic that guides us toward wise and measured decisions. When it comes to investing, this principle couldn't be more vital. The financial markets are infamous for stirring up a storm of emotions: fear when prices plunge, greed when assets skyrocket, and panic when uncertainty looms. Yet these intense feelings, while natural, often lead to the worst mistakes investors can make. The Stoic investor learns to rise above these emotional tides and instead let reason govern their actions. Why is this so crucial? Because emotional reactions are notoriously unreliable as decision-making tools. They are impulsive, fleeting, and frequently based on incomplete or biased information. Consider the typical cycle of market euphoria followed by despair. Investors buy high during bubbles, driven by greed and FOMO, only to sell low amid crashes fueled by fear and panic. This pattern results in buying at the top and selling at the bottom, the exact opposite of what builds wealth. The antidote is cultivating rationality as your guiding star. To do this, start by developing a clear investment thesis. This means thoroughly understanding why you are investing in certain assets or strategies. Are the companies you invest in financially healthy? Does the asset class align with your risk tolerance? Is the investment supported by sound data rather than hype? When your decisions rest on well-reasoned foundations, you are far less likely to be swept away by market noise or speculation. One practical and powerful tool to maintain rationality is the Investment Policy Statement, IPS. This written document codifies your financial goals, risk appetite, asset allocation, and specific rules for when to buy or sell. Think of it as your investment compass. During volatile markets or emotional episodes, referring back to your IPS helps you stay grounded, resist knee-jerk reactions, and keep your long-term strategy intact. The IPS is not static. It evolves with you, but always remains your anchor in turbulent times. Beyond planning, Stoicism encourages the practice of cognitive distancing, a mental technique that involves observing your emotions from a detached perspective rather than being controlled by them. When you feel anxiety rising as the market dips or excitement surging amid a rally, pause and reflect. Ask yourself, is this feeling based on solid evidence, or am I reacting to fear or hype? This distancing helps create a space between impulse and action, allowing you to respond thoughtfully instead of reacting reflexively. This process can be strengthened by journaling your decisions and emotional states. Document why you made certain moves, what information you relied on, and how you felt. Over time, this builds self-awareness and reveals patterns where emotion may have clouded judgment. Learning from these insights enhances your ability to cultivate rationality. The benefits of prioritizing logos in investing are profound. It guards you against common behavioral biases, such as herd mentality, blindly following the crowd, loss aversion, irrationally fearing losses more than valuing gains, and overconfidence, which can lead to reckless risk-taking. Instead, reasoned investing promotes patience, discipline, and resilience. Ultimately, embracing rationality turns investing into a calm, deliberate practice. It replaces anxiety and impulsiveness with confidence and thoughtful action. The Stoic investor does not seek to eliminate all emotions. After all, they are part of being human, but rather to master them so that decisions serve wisdom and long-term success, not fleeting feelings. Number 3, adopt a long-term perspective. One of the foundational strengths of Stoic philosophy is its emphasis on seeing beyond immediate circumstances and understanding events within a broader, more enduring context. The Stoics often spoke of taking the view from above, a mental exercise where you zoom out from your current troubles to see the vastness of the universe and the passage of time. When applied to investing, this perspective becomes a powerful tool to help you transcend the emotional turmoil caused by short-term market fluctuations and maintain your focus on long-term success. Investing is fundamentally a long-term endeavor. The reality is that true wealth creation rarely happens overnight or through quick wins. Instead, it requires patience, discipline, and the ability to endure volatility without panic or impulse. The market's daily ups and downs can feel like a relentless storm, but from the view from above, these fluctuations are mere ripples on a much larger ocean. When you zoom out and look at market returns over decades rather than days, the noise fades and the underlying growth trajectory becomes clear. Central to this long-term outlook is the principle of compound interest, which Albert Einstein famously called the eighth wonder of the world. Compounding allows your returns to generate further returns, creating exponential growth over time. But compounding only works when you stay invested consistently. Every premature withdrawal or poorly timed trade interrupts this process and can dramatically reduce your eventual wealth. A long-term mindset keeps you committed to the journey and shields you from impulsive decisions that undermine compounding. To cultivate this mindset in practice, it's essential to filter out the daily barrage of financial news and sensational headlines. News outlets and social media often emphasize dramatic stories about market crashes, bubbles, or economic doom, which provoke emotional reactions like fear and greed. These stories rarely reflect the bigger picture or your personal financial goals. Constant exposure to such noise can lead to anxiety, stress, and reactive behavior, like panic selling during a downturn or chasing overpriced assets during a rally. Instead, focus on what truly matters: your own financial goals, whether that's building a retirement nest egg, funding your children's education, or achieving financial independence. Keep these goals firmly in mind as anchors to remind you why you are investing. This clarity helps you avoid being swayed by short-term market movements or popular sentiment. Another critical aspect of the long-term view is learning to accept uncertainty and unpredictability as inherent parts of the market. No one, no matter how experienced, can predict exactly how markets will behave day to day, month to month, or even year to year. Recognizing this helps reduce frustration and the illusion of control. Instead of striving to beat the market, in the short term, focus on what you can control: your strategy, your savings rate, and your emotional discipline. The Stoics taught that external events are indifferent, neither inherently good nor bad, and that our judgment shapes how we respond to them. Applying this to investing means understanding that market downturns, corrections, and crashes are inevitable, and not to be feared but anticipated and prepared for. Viewing these events from a long-term vantage point lets you see them as natural phases within the broader market cycle, often offering opportunities rather than threats. Adopting a long-term perspective also fosters emotional resilience. It helps you resist the temptation to react hastily to market volatility, reducing anxiety and stress. Instead, it promotes equanimity, a calm and balanced mind, enabling you to stay the course and make rational decisions aligned with your goals. Ultimately, the view from above transforms your relationship with investing. It shifts your mindset from reactive to proactive, from anxious to composed, and from short-sighted to visionary. This elevated perspective empowers you to navigate market volatility with wisdom and confidence, allowing time to work in your favor as your investments grow steadily toward your financial aspirations. Number 4, practice premeditatio malorum. Prepare for market storms. Premeditatio malorum, or the premeditation of evils, is a cornerstone Stoic practice that involves consciously anticipating potential misfortunes before they happen. Far from being a pessimistic exercise, it is a deliberate mental preparation aimed at building resilience, reducing fear, and ensuring readiness for whatever challenges may arise. For investors, this principle is crucial because the financial markets are inherently unpredictable and often volatile, with downturns, crashes, and unexpected shocks occurring without warning. Rather than ignoring the possibility of losses or pretending markets will always rise, the Stoic investor embraces the reality that setbacks are part of the journey. This acceptance transforms fear from a paralyzing force into a proactive tool for strategic planning and emotional strength. Premeditatio malorum means you don't wait until a market crash to scramble for solutions. Instead, you think through what-if scenarios well in advance, so you have a clear, rational plan when trouble comes. One practical application of this principle is stress testing your portfolio. This means regularly assessing how your investments would perform under various adverse conditions, such as a sudden market crash, a prolonged bear market, or sector-specific downturns. By imagining and modeling these scenarios, you can identify vulnerabilities and take corrective action ahead of time. For example, you might find your portfolio is too concentrated in a volatile asset class and decide to diversify more broadly to spread risk. Diversification is another key safeguard aligned with this Stoic pillar. Putting all your eggs in one basket exposes you to unnecessary risk and potential ruin. By spreading your investments across different asset types, sectors, and geographies, you reduce the impact of any single negative event. Stoic wisdom teaches that prudence and moderation protect us from extremes, and diversification is a practical expression of this idea in investing. Maintaining an emergency fund is also vital preparation. Life is unpredictable, and unexpected expenses can arise at any time. Having readily accessible cash reserves prevents the need to liquidate investments during unfavorable market conditions, avoiding costly forced sales that can derail your long-term plan. Equally important is the mental preparation of rehearsing how you will react if the market takes a significant downturn. Stoics advocate for a calm, reasoned mindset rather than panic or impulsiveness. You might write down or mentally rehearse your plan. If the market drops 20%, I will hold my positions, possibly buy more to take advantage of lower prices, and rebalance as needed. This kind of pre-commitment strategy reduces emotional decision-making and reinforces discipline. By contemplating these negative scenarios in advance, you inoculate yourself against fear and anxiety when they actually happen. The shock factor diminishes, and you approach market turbulence with a sense of calm preparedness. This reduces the likelihood of panic selling or abandoning your strategy prematurely, common mistakes that often lead to significant financial losses. Premeditatio malorum does not mean expecting failure or being defeatist. Rather, it is about meeting reality with open eyes and a clear mind, so you can respond virtuously and effectively no matter what unfolds. In the chaotic world of investing, this mental rehearsal is a powerful defense that allows you to maintain rationality, protect your capital, and even find opportunity in adversity. Ultimately, preparing for market storms is not just about protecting your money. It's about cultivating inner strength. The Stoic investor understands that peace of mind and emotional resilience are as important as portfolio returns. By practicing premeditatio malorum, you build both, ensuring you stay the course with confidence, come what may. Number 5. Detach from outcomes. Embrace the process. One of the deepest teachings of Stoicism is that true contentment comes not from controlling external outcomes, but from committing fully to virtuous action, doing what is right, disciplined, and within your control, regardless of the result. In investing, this principle challenges the common obsession with chasing returns and fixating on short-term performance. Instead, it calls for shifting your focus from the unpredictable results of the market to the integrity and consistency of your own decisions and behaviors. The financial markets are influenced by countless factors: economic cycles, geopolitical events, market sentiment, that no individual investor can fully predict or control. Despite all the research, analysis, and planning, outcomes remain uncertain. The Stoic investor accepts this reality and avoids becoming emotionally attached to specific financial goals or return figures. This detachment is not indifference or passivity. Rather, it is a mindful recognition of the limits of your influence. Instead of measuring success solely by portfolio gains, the Stoic investor measures success by the quality of their process and adherence to sound principles. Did you conduct thorough research before investing? Did you follow your pre-established asset allocation and risk management rules? Did you resist impulsive reactions driven by fear or greed? These questions focus on what you can control, the decisions you make, and the discipline you maintain. By embracing the process over the outcome, you cultivate resilience against the inevitable ups and downs of investing. When the market dips, you don't spiral into despair. You remind yourself that your virtue lies in sticking to your strategy and making rational, well-informed choices. When the market rallies, you don't become overconfident or reckless, but maintain humility and cautious stewardship of your assets. This approach also reduces the emotional roller coaster that many investors endure. Obsession with outcomes often leads to stress, anxiety, and rash behavior, which undermine long-term success. In contrast, focusing on virtuous action fosters peace of mind and steadiness, as your sense of achievement is grounded in your own effort and character rather than external validation. Moreover, detachment from outcomes encourages continuous improvement. When results don't meet expectations, instead of blaming the market or feeling defeated, you objectively analyze your process. What decisions went well? Where can you improve? This mindset supports learning and growth, turning setbacks into valuable lessons rather than sources of frustration. The Stoics teach that happiness depends on living in accordance with reason and virtue, not on external circumstances. Applying this wisdom to investing transforms it from a source of stress into a practice of discipline, patience, and self-mastery. By committing to the process and letting go of attachment to results, you build a foundation of lasting calm and confidence that outperforms short-term gains. In essence, this pillar invites you to be a Stoic sage in the world of investing, focused on right action, prepared to accept whatever outcomes arise with equanimity, and dedicated to steady growth through virtuous practice. This mindset not only improves your investment outcomes, but also cultivates inner peace, the ultimate form of wealth. Number 6. Resist herd mentality and external noise. In the chaotic and often overwhelming world of investing, one of the greatest challenges is resisting the pull of herd mentality, the tendency to follow the crowd blindly without independent thought. Stoicism teaches us the value of autarkia, or self-sufficiency in judgment, which means trusting your own reasoned decisions rather than being swayed by popular opinion, media hype, or social pressure. This inner directedness is essential for rational investing and protecting your capital from the dangers of emotional contagion and speculative bubbles. The financial markets are notorious for swings driven not by fundamentals, but by mass psychology, fear, greed, hype, and panic. Investors frequently fall victim to the fear of missing out, FOMO, rushing into hot trends without proper analysis, or conversely, the fear, uncertainty, and doubt, FUD, that causes panic selling. These emotional drivers are contagious and can lead to irrational market behaviors, causing many to buy high and sell low, the exact opposite of prudent investing. Stoicism calls for developing a strong inner compass that guides your investment decisions, independent of the noisy external world. This starts with cultivating critical thinking and doing your own thorough research. Instead of accepting market narratives or hot tips at face value, evaluate the evidence, analyze the fundamentals, and challenge assumptions. This intellectual discipline prevents you from getting swept up in hype cycles or misleading information. Another key practice is to stick to your own investment plan, even when the crowd is behaving irrationally. Whether others are euphoric and bidding prices to unsustainable highs, or panicking and driving prices down, your role as a Stoic investor is to maintain steady composure. Having a clear investment policy statement, IPS, that outlines your goals, risk tolerance, and rules helps anchor you to a rational framework. When fear or greed tries to hijack your decisions, refer back to your plan. It acts like a mental shield against impulsive behavior. Marcus Aurelius famously said, "The opinion of 10,000 men is of no value if none of them know anything about the subject." This Stoic wisdom reminds us that popularity is not proof of correctness. The crowd can be wildly wrong, and the most profitable investment opportunities often lie in going against the grain, buying when others sell in fear, and selling when others are irrationally exuberant. By cultivating inner directedness, you become less reactive to market noise such as sensational headlines, social media chatter, or short-term market swings. Instead, you develop a calm, measured approach that prioritizes reason over emotion. This mindset not only protects you from costly mistakes, but also positions you to capitalize on opportunities missed by the majority. In short, resisting herd mentality is an act of courage and wisdom. It requires confidence in your own judgment, patience, and discipline to stand apart from the crowd. This pillar of Stoic investing empowers you to be an independent thinker who navigates the market's emotional turbulence with clarity and control, ultimately leading to more consistent and rational investment success. Number 7, regularly review and reflect with wisdom. The Stoics placed great importance on the practice of self-reflection, often through journaling, as a way to cultivate wisdom, self-awareness, and personal growth. Marcus Aurelius's Meditations is a prime example of this practice, regularly recording his thoughts, decisions, and lessons learned. For the Stoic investor, maintaining a similar habit of thoughtful review can be transformative, helping you learn from both successes and failures, stay aligned with your principles, and continuously improve your investing mindset. Investing is a dynamic journey, not a one-time event. Markets evolve, economic conditions shift, and personal circumstances change. Without regular reflection, it's easy to drift from your original goals and strategies, or to repeat behavioral mistakes that cost money and peace of mind. By keeping an investment journal, you create a disciplined process for tracking your decisions, the rationale behind them, your emotional state at the time, and the eventual outcomes. This journal serves multiple critical functions. First, it helps you identify behavioral biases that might be influencing your decisions, like overconfidence, loss aversion, or herd mentality. For example, did fear cause you to sell prematurely during a downturn? Did excitement push you to buy a hyped asset without sufficient research? By objectively recording these moments, you can spot patterns and work actively to correct them. Second, your journal provides a platform for periodic review of your investment goals and strategy. Are your investments still aligned with your risk tolerance and long-term objectives? Has your strategy become outdated or too reactive to short-term events? Regularly revisiting your plan with clear-headed wisdom helps you make reasoned adjustments instead of impulsive changes driven by emotion or market noise. Third, reflecting on your decisions reinforces accountability and discipline. Writing down your process before making a move encourages careful thought and reduces impulsiveness. Reviewing past entries builds humility and patience, as you acknowledge that even well-planned actions sometimes have unexpected outcomes, an essential acceptance in the uncertain world of investing. Finally, journaling fosters continuous learning and growth. Each entry is a building block for improving your judgment and emotional resilience. Over time, this reflective practice deepens your understanding of the markets and yourself, making you a wiser, more confident investor. Incorporating this Stoics pillar into your investing routine transforms the practice from a mechanical task into a mindful discipline. It empowers you to navigate uncertainty with clarity, correct mistakes without self-criticism, and maintain a steady course toward your financial goals. In essence, the Investor's Journal is your personal Stoic tool for turning experience into wisdom, aligning your actions with reason and virtue, and ensuring your journey toward wealth is also a path toward inner peace. As we've explored, the path to successful investing isn't paved solely with financial formulas or market predictions. It's anchored in mastering your own mind. The 7 Stoic pillars provide more than just strategies. They offer a timeless blueprint for cultivating rationality, discipline, and emotional resilience in the face of market chaos. By embracing what you can control, practicing reason over emotion, preparing for adversity, and reflecting with wisdom, you not only protect and grow your wealth, but also nurture a profound sense of inner peace. Remember, investing like a Stoic is not a quick fix or a get-rich-quick scheme. It's a lifelong practice of mindful action and steady growth. The true advantage of this philosophy lies not just in the returns you earn, but in the calm, confidence, and clarity you develop along the way. When fear and greed no longer dictate your decisions, you become a steady investor, a rational thinker, and ultimately, a wiser steward of your financial future. So take these 7 pillars as your compass through the storms of market volatility. Commit to the process, stay grounded in virtue, and watch how both your portfolio and your peace of mind flourish over time. The Stoic investor's journey is not just about wealth, it's about living a richer, more intentional life,